So hi everyone. So it's left to me to bring the session home. A few of you have said to me, are we leaving the best till last, Dawn? Let's see. Let's see how this goes. So it's great to see you all today. Yesterday, we talked about the near term, where we shared our solid Q1 performance. And today, our focus is looking ahead and focused on the medium term. We have set ourselves an exciting ambition to unlock our full potential. Over the course of the afternoon, you have heard from my colleagues about the exciting opportunities for Haleon. What I'm going to do is to pull everything together to show how this translates into our new value creation framework. You heard from Brian about the opportunity ahead. Our ambition is to reach 1 billion more consumers by 2030 and deliver industry-leading returns. By driving continued top-line growth, by growing our operating profit through leveraging gross margin expansion, and through continued evolution to be a more agile and performance-focused organization. We start from a very strong position. We have delivered industry-leading organic sales growth, at least in line with our 4 to 6% target. We have generated strong free cash flow. We delevered faster than expected, from 4 times to 2.8 times, and we returned around £1.5 billion to shareholders through a combination of dividend and share buybacks. This strong financial performance demonstrates our ability to deliver on our commitments while building a platform for sustainable future growth. But we believe we can and should do better, especially in the area of operating leverage. Over the last 3 years, we have delivered an increase in adjusted operating margin of 80 basis points at constant currency. But this performance has been adversely impacted by the drag from foreign exchange. The net result is that our adjusted operating margin has declined 50 basis points, and our adjusted operating profit has been broadly flat in absolute terms at £2.5 billion. Despite this drag, and excluding the standalone impact from demerger, our EPS CAGR has been 5%, due to reductions in annual net interest costs, non-controlling interests, and reduced share count through share buybacks. Moving forward, delivery of consistent operating leverage through the P&L is a key priority for me. So stepping back, why is Haleon an attractive investment case? We are the leader in a global market of about £200 billion. We operate in attractive, resilient categories, underpinned by long-term consumer tailwinds, growing at around 3 to 4%, and we have a diverse geographic footprint. We have an exceptional portfolio of superior brands and leading capabilities in expert, pharmacy channel, and science. And we have consistently grown volumes and taken market share. Our updated value creation framework has 3 components: operating leverage from top-line growth, strong free cash flow generation, and disciplined capital allocation. We have plans in place to deliver against each of these components, and we are disciplined and consistent in our assessment of performance KPIs. To help drive performance, remuneration is linked to all key levers of value creation: revenue growth, operating profit, EPS, and cash metrics. You will see many elements are unchanged from our current framework. The key shifts are a step up in our profit guidance to high single-digit adjusted operating profit growth at constant currency, underpinned by gross margin expansion. This reflects our ambition to leverage strong revenue growth to drive operating leverage more consistently to the bottom line. Stronger free cash flow generation underpinned by laser focus on working capital improvement. And a disciplined approach to capital allocation that balances shareholder returns with value-enhancing bolt-on acquisitions. Let me start with organic revenue growth. As Tamara and Frank outlined, there is substantial headroom for future growth across our categories. We will unlock this by driving health in more hands through our superior brands and leveraging our strong geographic footprint. Currently, around 2/3 of our sales come from developed markets, where we will continue to drive core penetration and premiumization through innovation, as well as leverage our route-to-market strength in pharmacy. In emerging markets, we've achieved double-digit growth over the past 3 years. We will unlock category growth and drive penetration by closing the incidence versus treatment gap and broadening our reach to lower-income consumers. We will continue to focus on key markets such as India and China, as well as accelerate performance in the US. These strategies will lead to a balance of growth between price and volume mix. Turning now to gross profit. Haleon already has an attractive adjusted gross margin of 63%. This is driven by several factors: the quality and resilience of the consumer health segment itself, our leading category positions that enables us to leverage the benefits of scale and pricing power, and our product superiority, which drives premiumization. To expand margins further, we will deliver £800 million of gross supply chain productivity savings. This £800 million will be equally spread over the next 5 years. In the near term, productivity savings will come from complexity reduction and operational excellence, with network optimization and robotic savings kicking in over the medium term. We've made good progress in laying the groundwork for these initiatives and are already up and running. The costs to deliver these savings over the next 5 years are threefold. An increase in our average Capex spend from 3 to 4% of revenue, £300 million one-time restructuring and asset write-off costs, of which 2/3 are non-cash, and an increase in supply chain OPEX spend as well as we invest in leading capabilities. The £800 million of gross benefits will enable a more agile and efficient operating model, which will unlock significant value for our stakeholders. Let me walk through how these savings will translate into gross margin expansion. We will continue to drive balanced growth through pricing and volume mix. Gross productivity savings will be offset by COGS inflation, as well as the incremental costs I just mentioned, incurred to build the future supply chain capabilities. A good example of this is our investment to enhance our supply and demand planning that Namrata talked about. I would like to emphasize that our gross margin guidance takes into consideration the mix effects, which we will look to manage as we drive our growth across faster-growing geographies and new consumer cohorts. Moving forward, gross margin expansion will provide optionality, flexibility, and agility in the P&L. To drive top-line growth, maintaining the flexibility to invest in advertising and promotion is a key area. At 19.2% of revenue, our A&P is already at a very healthy level today. We have also shown that we will retain the flexibility to dial up or down depending upon competitive dynamics and to accelerate our strategic choices. For example, you have seen us devote spend in high-growth markets such as India and to support successful innovation such as Sensodyne Clinical White. But it is also important to ensure that we allocate our spend effectively to ensure our brands continue to be top of mind with existing consumers and to reach new consumers. We are focused on strengthening further the ROI of our spend in the following areas: more efficient media buying to beat inflation by 50%, allowing our investment to go further despite market pressures, and increasing the proportion of our spend on expert, digital, and social channels to connect with over 80% of dentists and pharmacists across our key markets. Moving now to look at R&D. Investment in R&D underpins our strong science capability and innovation platforms. We have a strong track record of delivering growth through innovation, which, combined with superior evidence generation, drives product superiority and underpins expert recommendation of our products. You have seen many examples of this today across Sensodyne, Otravin, and Centrum. In addition, growing our technical capabilities is a key focus for us, we'll continue to invest to grow our R&D infrastructure and capabilities that deliver the science and experience of our solutions. For example, as Frank mentioned, we have our new state-of-the-art R&D facility coming online in Slovakia at the end of 2026. We are also investing in our R&D digital tech infrastructure, including regulatory and clinical systems, which will enable us to be future-ready to dial up innovation. We are on a journey to make Haleon more agile and performance-focused. To support this, we're driving process simplification and leveraging technology. We are on track to complete our £300 million productivity programme in 2025, aimed at achieving an efficient organisation. Haleon Business Services will drive multifunctional, end-to-end process simplification and digital enablement, while building capabilities for the future. In digital and technology, we're embedding AI, enhancing analytics, and improving our e-commerce capabilities through a clear digital strategy. We recently piloted self-service customer ordering and e-commerce portals in Europe with great feedback, and are planning global deployment over the next 2 years. These technology-enabled improvements are helping us to optimize our end-to-end value chain, increasing speed, agility, and improving efficiency. So recapping what we're targeting, we will deliver adjusted gross margin expansion, on average 50 to 80 basis points a year at constant currency, providing flexibility in the P&L to ensure healthy investment in A&P and R&D to drive growth. We will continue to optimize our other SG&A costs to drive operating leverage while investing in future capabilities. Together, this leads to a step up in our profit guidance starting in 2026 to deliver high single-digit adjusted operating profit growth at constant currency. An important step to ensure we deliver consistent leverage through the entire P&L. I want to turn now to foreign exchange. Our translational foreign exchange P&L impacts have been driven by 2 main factors: a mismatch in currency between revenue and costs, resulting in a higher currency impact at operating profit versus revenue, and strong growth in emerging markets, where higher inflation typically results in higher currency deflation. Over the last 10 years, despite a tailwind in G10 currencies, we have seen an average annual drag from currency of 0.5 to 1% on organic revenue and 2 to 2.5% on organic operating profit. So what can we do to address this? Clearly, we cannot control currency markets. It would be great if we could, especially at the moment. There is no quick fix. So our focus will be on the areas that we can influence, driving harder our constant currency operating leverage, which is more within our control, to provide more buffer to currency moves. taking proactive steps to try and minimize the impact of currency over time and reduce volatility, including looking to minimize the mismatch between costs and revenues, reviewing our manufacturing strategy as outlined by Namrata, and further embedding currency into investment and pricing decisions. As you saw in February, we have also changed our forecasting approach from using spot rates to Bloomberg consensus forward rates to try and better reflect forward projections in emerging markets. Whilst this in itself is not a mitigation lever, it should provide more visibility on annual foreign exchange impacts. Let's now turn to the second part of our value creation framework, strong free cash flow generation. Haleon is a highly cash generative business. Last year, we generated free cash flow of £1.9 billion. Benchmarking shows significant opportunity in working capital, especially in inventory. Many of the supply chain initiatives Namrata shared earlier will unlock the inventory opportunity. We have set a target to reduce working capital cycle time by 30% over the next 5 years. Working capital efficiencies will cover additional Capex investment required to drive productivity. Our aim will be to deliver working capital improvements in a sustainable way to generate a more balanced cash flow throughout the year. By combining this with operating leverage, continued optimization of tax and interest, we will look to drive strong overall cash flow moving forward. In terms of Capex investments, there are 2 key messages I want to share. First, we expect to increase average Capex spend to around 4% of revenue over the next 3 to 5 years. This reflects an increase to drive our growth and productivity agenda, as well as investments in data, AI, and sustainability. Second, Capex spend is currently balanced between 50% of spend on productivity and growth and 50% on maintenance. Moving forward, this will shift towards a 65-35 split, with 65% being spent on growth and productivity and 35% being spent on maintenance Capex. We are also embedding currency into our supply strategy and investment decisions. And we will maintain our discipline in achieving internal rate of return, hurdle rates, and attractive payback periods on investments. This overall strategic shift in Capex will strengthen our capabilities while supporting our long-term growth ambitions. As we exit our 5-year plan, I would expect to see Capex as a percentage of revenue to start trending back towards the 3% level. Let's move to look at our disciplined capital allocation. Based on our strong and improving free cash flow, we are well positioned to deliver on our capital allocation framework. Our priorities are unchanged and focus on balancing investment for growth and delivering attractive shareholder returns. As outlined earlier, we're investing for growth and investing in productivity. Our M&A approach will shift from divestment focus to bolt-on acquisitions in strategic growth areas where we see attractive returns, and I'll come back to this shortly. For shareholder returns, we will continue to grow dividends at least in line with adjusted earnings, and we will return surplus cash to shareholders in the form of buybacks or special dividends. All of this is underpinned by a strong investment-grade balance sheet and our target leverage of around 2.5 times net debt to EBITDA. Let's briefly look at M&A. We have been proactive in managing our portfolio. To date, our divestment strategy of non-core brands has delivered over £1 billion in share proceeds. Whilst these divestments were the right thing to do strategically, we recognise that they have had a dilutive impact to margins in the prior years and in 2025. On average, over the next 5 years, we will look to manage the dilution of any potential future divestments through a better balance with growth accretive acquisitions. We have defined a clear set of criteria and priorities for targeting bolt-on acquisitions. Our aim is to strengthen depth and breadth in our existing categories by addressing either a geographic or portfolio gap. Any acquisition must have, first, a strong strategic fit in the areas of our current strengths: brand superiority, expert, and science. Second, a strong market position, brand equity, and opportunity for clear differentiation and competitive advantage. Third, any acquisition must deliver strong financial returns through EPS and return on invested capital. And fourth, the potential to deliver at least 4 to 6% growth on a consistent basis when on the Haleon platform, and to be either margin accretive from the start or have a clear near-term pathway to get there. To sum up, our value creation framework underpins the next chapter for Haleon. By leveraging our superior brands to deliver health in more hands, we are confident that we will continue to deliver against our medium-term target of 4 to 6% annual organic revenue growth. This growth, alongside our Wired for Excellence initiatives in supply chain, will support, on average, 50 to 80 basis points per annum of adjusted gross margin expansion, which in turn enables financial flexibility and agility through the P&L, and our strengthened commitment to drive operating leverage more consistently to the bottom line. As a result, we have updated our medium-term profit guidance to high single-digit adjusted operating profit in constant currency. This includes a recognition that M&A should deliver a better balance of accretive bolt-on acquisitions to offset any dilutive divestments going forward. In turn, we expect to deliver strong EPS growth and free cash flow generation. Overall, this will enable us to deliver on our ambition of reaching 1 billion more consumers by 2030 and deliver industry-leading returns. With that, I'll hand back to Brian.